Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. Welcome to the last week of March 2020. It has been a stressful and wild last few weeks in the financial markets, but that pales in comparison to the stories of heroism and the fantastic job that the first responders and doctors are doing out on the front lines working with COVID-19 patients. But we've been working very diligently with our clients at Lanton Investments, and I know the people at Bernard Herald have been doing the same. Want to reiterate something that Kevin Leahy said to me and a few others on Friday, that we had just gone through very unique few weeks in the financial markets, many of us working at home in conditions that we weren't used to, and want to praise everyone for doing a fantastic job in stressful times. We are working with our clients to create the best possible future for them financially, and their financial success is very closely aligned with their mental outlook and their view of the world, which each individual is experiencing something different and unique, and we are serving an important function in speaking with our clients in this stressful time and reassuring and reevaluating their current accounts and their current values to make sure that they are in the right place mentally in order to forge forward with whatever they have going on in their lives. So commend everyone for the work that they did last week. I know there's a lot more work to do as we move forward. As Kevin said to me, think about what you did last week and what you learned from it. Write it down. Think about it. Think about what you did that was really fantastic that you could do again. Or think about, hey, I could improve this aspect. I could do this a little bit better, so that each week we continue to improve and continue to be able to provide outstanding advice and outstanding customer service to our clients. Now, if you woke up 55 years ago today, you would have woken up to a headline that would have been at the moment perhaps something that you'd say to yourself, my goodness, what's this going to do to the financial markets? What's this going to mean for me and my family in this world? And the headline 55 years ago was, Bomb Explodes Outside U.S. Embassy in Saigon. The embassy was virtually destroyed by a bomb that killed 19 Vietnamese, 2 Americans, and a Filipino. You can imagine the distress that bore on those who were personally affected, as well as by those who opened up at that time. They weren't getting their news on the internet, but they opened up the front page of their newspapers and saw this all over the front page and the ensuing news and headlines and events that we know unfolded. Now, the point here is that while this was certainly a very significant news 55 years ago, if you opened up that newspaper 55 years ago, you probably thought that this was an earth-shattering, market-moving, fantastically important event, and you were projecting how it was going to affect things for the foreseeable future. And as we know, this event did have an effect on the foreseeable future. But my point is that today, 55 years ago today, it's literally a small dot in the in all of the history that has taken place in the past 100 years. It's something that people barely remember or recognize. So try and put, not to diminish the events of today, and not to say that they are of equally importance or prominence, but to try and keep perspective when we look back on what we're going through and what the current environment is, and to keep perspective and to make sure that you maintain your thought process as we go through this market environment, and to keep cool heads and focus on what the long-term plan is. thinking about the long-term plan. If you were to wake up this morning, and this is something that becomes more and more poignant here as we turn on the TVs or go to websites and we see the horrific figures with respect to coronavirus, and we see the number of people infected and the number of people who have tragically passed away as a result of coronavirus, and we start to hear some people even in the financial community, the CFO of Jefferies, who was in his 50s, passing away from coronavirus. And it is something that has that silver lining of making us think about ourselves and our lives, and to think about what would happen if you were to wake up today and find out you had a finite amount of time to live. How would you do things differently? How would you approach your life differently? And I was reading an article from someone who was thinking about this, and he or she was conjecturing on all the little things that we stress over during the course of a day. Perhaps you recently got a new car, and you've been working to keep that car pristine, and suddenly your child or niece or nephew comes in with an ice cream cone and soils that new car, and you think that is something that has tragically influenced your day. And the point is if you had a finite amount of time to live, would having a clean back seat in your car be something that you would be focused on? Is it something that you should be focused on if life happens and something gets soiled? Does it really matter? Does it really matter if it wasn't an ice cream cone, but it was a brand new car and you got into a fender bender? Would that be something that you would truly focus on in that 6-month period that you have to live? And what the coronavirus perhaps enables us to do is to set our egg timer, and for us to focus and prioritize on what really matters: relationships, inhaling life, walking in the park. It is the silver lining is it does give us an opportunity to reset what we care about, and in all likelihood, what those things are won't be things. We are currently at war with an invisible virus. The number of people, though, in the United States who so far died from the virus, and this is not to minimize it, but to provide some context, is less than the number of people who would have died by choking over the same period of time. Nevertheless, this is something that can get significantly worse. It's something that we need to take seriously. Here at Lanton, we are maintaining social distance if we're in our offices. Many of our people are working from home, so in no way mean to diminish the seriousness, but also want to point out that we are going to move forward, march on, and do the best we can in our personal lives and in our professional lives. And we do have this unique opportunity to think about and divorce ourselves from many of the material things that we have focused on over the past 18 years, and to reset and perhaps focus and spend more time with family. And this is an opportunity to really spend time with them. And what I mean by that is you're not necessarily going to a ball game or to a Broadway show or to Disney World, but you're actually being able to engage in conversation and time with them without that subset of fun or entertainment coming from an outside source. So we do have this opportunity to prioritize, and you can think of it as being able to prioritize in many instances without the guilt of thinking, well, I should be doing this, I should be making that, but the opportunity to set aside some time and put the material world on hold for at least a few weeks. Now, back to the financial markets. This morning, last I looked, and as all of you know, things change very rapidly in this environment we're in. In fact, last week, Monday we were down 3%, Tuesday we were up 11%, Wednesday up 2.5%, Thursday up 6.5%, Friday down 4%. So certainly we've been seeing significant volatility in the markets. We're now seeing Dow futures up about 100 points, S&P futures up about 20, NASDAQ futures up about 60. But we are certainly not beyond the all clear sign, not out of the woods. Keith Douglas sent me, which I'll re-forward out, or Keith can send out, what I thought was an excellent article from the Wall Street Journal, How I Learned to Stop Worrying and Love the Bear Market. Everyone thinks they're a genius in a bull market, but it's only when prices head south that some people really stand out from the crowd. As odd as it sounds, the average investor is woefully below average. Compared to a robot who might invest through good and bad times ignoring headlines, a fallible human can end up with a lot less money on retirement day due to greed and fear. Sure, some investors will claim they saw the coronavirus-induced bear market coming, just like there are people who said they sold ahead of the housing bubble or the dot-com bubble. Maybe some of them are telling the truth, but there were plenty of excuses to take profits over the past decade in what became the longest bull market in history. We had the trade war, we had the European debt crisis, we had ludicrous unicorn valuations, we had the U.S. downgrade, we had Brexit, we had Greece's teetering on the verge of extinction and bankruptcy, we had North Korea lobbing missiles, we had the U.S. pulling out of the Iran deal and going into a very tense standoff with Iran. And that's just to name a few of the events that have taken place in the most recent bull market. Up until a month ago, acting on any of them would have cost you. On the investor psychology in a major bear market is a mirror image of what it was the past few years. The more false alarms there were along the way, just as the ones I just described, the likelier investors were to embrace risk, viewing dips as a buying opportunity. On the way down, which we're currently in, suckers rallies, and the technical bull market we reached on Thursday, which was the result of the market going up 20%, may have been a situation where we had a suckers rally, and they may prove, nobody knows, prove to be something that ultimately gets crushed, and that optimism gets squashed. By the time a really prolonged bear market is about to end, investors who have sold and discussed probably have a lower percentage of their net worth in stocks than they did at the outset, and that is one of the costliest mistakes investors can make. A surprising share of new bull market runs returns pile up in the very early stages when people are most fearful. Take the one that ended last month, putting $100,000 into an S&P 500 index fund on the day the bull market began, March 9, 2009, and selling at last month's peak would have turned $100,000 into $630,000. But if you had waited just 3 months beyond March 9th, if you had waited until June 9th, when markets were still very low, 2009, and you decided now is the all clear, and you had put your foot in the water at that point, instead of having $630,000, you would have $450,000. In other words, by waiting 3 months, you would have sacrificed 34% of the gains that took place over those 11 years. And the difficulty is if you wait for happy headlines or a hopeful government statistic for a clue on when to pounce, you'll probably be too late. Making lemonade out of lemons sounds tempting, but it isn't easy. The old saw goes, when the stock market is the only one where people run away when there's a sale. Beforehand, they crowd in when everything is the most expensive because they see everyone getting rich. For example, in the 10 months leading up to the last peak in October 2007, $84 billion flowed into equity mutual funds. By contrast, $233 billion flowed out between June of 2008 and March of 2009. So $84 billion in right before the peak, and we saw $233 billion out just before the end. So something to think about as investors and as advisors. If the last month truly convinced you that you had too much money in stocks to sleep well at night, then take your lumps, dial back your risk permanently. But if you're merely waiting for a sign that it's safe to buy and hold, then just hold your nose, increase your allocation to equities, and learn to love a bear market. So moving on, I sent out a piece this morning on some of the provisions in the stimulus bill that apply to small businesses. I suggest taking a look at it. I know that I have personally received phone calls and emails from clients who are asking me for guidance on what they as business owners or small business owners can, should, or will be able to do as a result of what's being called the CARES Act. Now, I certainly am not an expert, don't have the answers, but I am passing along the information that I receive, just the facts, to those clients and letting them know that all the details have not been worked out. We're still waiting for clarifications from things like the Labor Department in order to be able to truly understand some of the implications of the CARES Act. But as you can imagine, many of our clients are unable to reach their trusted advisors, whether it's their accountants or attorneys, and we, being available and in the office, are a resource that is available to them. So I am trying to just pass on the information to them, clearly not acting in a capacity as an accountant or lawyer, but merely passing on the facts to them. And this is something that we can do and add value in this time here, as many of their other sources of information are not available. So moving on, this morning, a couple of stories in the news this morning. Abbott Labs has said that they won U.S. marketing approval for a diagnostic test kit for coronavirus that can deliver results to patients within minutes and be used in physicians' offices and urgent care clinics as well as hospitals. So that stock moving higher, and that's both good news for the stock and good news for all of us in the fight here against coronavirus. I mentioned the equity markets on the upswing at the moment, and the bond market is up as well, although giving up a little bit of their gains as equities start moving higher. If you were watching the overnight session, you'll have noticed that futures were down most of the night, not precipitously, but 1 or 2%, which I guess these days is not precipitous. But now the plus side, obviously, going to remain volatile. The 30-year Treasury is up 9 basis points. When I say up, I mean down in yield. So we are looking at a 124 yield on the 30-year. That's down from a 133 on Friday. The 10-year is down 9 basis points to 65 basis points. The 5-year is at 39 basis points. And the 3-month, interestingly, the yield is up, which is a positive sign. We are no longer negative on the 3-month. We're up to 5 basis points this morning. Want to give you some information on oil, which was down earlier. And right now, taking a look here for the price of oil this morning is down $1.37. I believe oil was below 20 earlier. It's now at $20.14. That is for West Texas Intermediate. Brent crude is at $22.77, down $2.16. Natural gas unchanged. Gold is down about $13 an ounce to $1,641 this morning. U.S. dollar is meaningfully stronger this morning, up about 0.75% against a basket of currencies. A couple of other stories this morning. Barron's ran a few different articles, really a cross current of opinions. I would say that overall Barron's probably more cautious, but was certainly a splattering of some optimistic articles as well as some more cautious articles. One entitled "Bear Market Rally Doesn't Signal Quick Revival for Stocks." Thesis of this article is that it will be challenging, to say the least, for the U.S. to be able to reignite the engines and restart the economy once the COVID-19 is no longer as much of a threat. Unprecedented in the U.S. to turn the economy off and turn it on again. To a large extent, certainly things still operating like the financial markets, but many businesses and industries are shuttered. The headline story in Barron's: the Dow ignored the spread of coronavirus last week. It won't be able to anymore. But the optimistic note in this article is that in 2008, the Fed and Congress dithered as the financial system crumbled and the economy slumped. But in this crisis, even though last week it felt like it was going a little slow and we had a few speed bumps along the way, the Fed took the kitchen sink and they threw it into the market. And then Wells Fargo strategist Chris Harvey says then they took another kitchen sink and they threw it into the market as well, and that was the fiscal stimulus. And the speed of the fiscal stimulus and the monetary stimulus is unprecedented. You go back to 2008, fiscal stimulus took significantly longer to arrive. Monetary stimulus was a much slower process. So literally within the course of 10 days, you had interest rates slashed to zero, and you had $2 trillion in stimulus put into the system. So when you compare 2008 and 2020, the significant difference is the speed of reaction that was delivered to the patient, or the speed the medicine was given. Of course, we don't know how the U.S. economy, the patient in this analogy, is going to fare, but we do know that the medicine was delivered very quickly, so past is not necessarily prologue to the future. A couple of other stories in Barron's. Barron's talked about SoftBank, symbol Sam Frank Delta Boy Yankee, and Barron's acknowledging that they were prematurely optimistic about SoftBank, and the stock has fallen significantly since then. But they remain positive on SoftBank, and they point out that SoftBank is selling for a 66% discount to its assets. Put another way, SoftBank has holdings worth almost triple its current stock price. They talk about some of the declarations and proclamations SoftBank made last week, where CEO Sun announced that SoftBank was going to plan to sell $41 billion in assets over the next 12 months, use $18 billion of the proceeds to buy back stock, on top of the existing $4.8 billion stock buyback they have going on. Other $23 billion is going to use to pay down debt, and Barron's feels that is a catalyst that will continue to move the stock higher. The stock did move up on that initial news, but Barron's thinks the possibility for further appreciation is there. Barron's also wrote an article, 25 tech stocks for a post-coronavirus world. Won't go through all of them, but give you some of the highlights. Rich Greenfield was bullish on Twitter. He did acknowledge that in the past week, Twitter warned that revenue for its March quarter would be down year over year as ad budgets fall. But he notes that Twitter is seeing record usage. While profits and revenue will take a near-term hit, he points out that Twitter can withstand the crisis. They have $6.6 billion in cash on hand. That's about a quarter of the market cap of Twitter. Paul Meeks of Independent Solutions Wealth Management suggesting that he finds value in mega caps, specifically Amazon and Alibaba, both of which he thinks will benefit from their expanded role in e-commerce, and the role that e-commerce will play in the post-coronavirus world. Paul Meeks also suggesting that the new industrials are semiconductor stocks, like earth-moving equipment and steel were the tools that went into previous revolutions or industrial revolutions. His thesis is that semiconductor stocks are the bricks and mortar that are going to go into the products and services in the technology revolution. So he is favorable on stocks like Lam Research, Taiwan Semiconductor, Micron Technologies, and Applied Materials, which he thinks will be beneficiaries as the economy begins to recover. Dan Niles, who is running a tech-focused hedge fund, who has been very bearish on technology and says he remains bearish on the market, although he removed a lot of his shorts, says that he thinks that there is still opportunity in companies that make video games, thinks the trend around video games that is somewhat benefiting from new video game consoles from Microsoft and Sony expected this fall, as well as the fact that many people who are home and are self-quarantining and entertaining themselves with things like video games, and these people will become further immersed in the gaming world, and he suggests companies like Zynga, ZNGA, Take-Two, TTWO, Electronic Arts, EA, and in China, NetEase, NTES, and Tencent Holdings. One additional silver lining to the turmoil is the lower rates that we're seeing, and the lower rates usually translate into lower interest rates for mortgages. And Barron's talking about whether or not now is a good time to refinance your mortgage, and whether or not it's a good time for clients or investors to refinance their mortgages. And the conclusion is that rates have certainly dropped as bond yields have come down, but of course no one's got a crystal ball. But perhaps you are best off waiting to refinance, because there has been such a crush of demand to refinance mortgages as a result of the lower rates. At the same time, there are less people available to process mortgages because of the stay-at-home policies surrounding coronavirus. So you put those two situations together, you've got a lot of demand and you don't have a lot of supply to meet that demand. So what a lender is doing is some lenders are no longer passing along the decline in interest rates because they are using the higher rates as a means of A, earning a higher profit margin, but B, being able to temper the demand that they're seeing that they are unable to satiate. So perhaps once demand and this surge to the door abates, at the same time, perhaps as more processors and mortgage individuals go back to work, there'll be ability to process those mortgages more effectively, and perhaps rates will decline. So, to give you an idea, 30-year mortgage rates are hovering around 3.5%. 15-year mortgage rates are in the 2 7/8 to 3% range. Given where we are in the Treasury market, those rates on a relative basis seem to still be on the higher side, and potentially could come down. Of course, if rates move up in the interim, then that will not be the case. Moving on to the bond market. In 1 second, I'll turn things over to Brad. Just going to tee it up for him. Barron's ran an article, Muni bonds have started to rally, why you should get on board and where to find bargains. As many of you are aware, last week was, at least in my almost 30 years in the business, an unprecedented week, not only in the stock market, but in the bond market, and in particular in the municipal and the corporate markets. I have never in my experience seen the volatility that I saw, and I have never seen the volatility go up and down so quickly in the markets in my 30 years. Never seen anything like it. So we saw a very sharp sell-off in munis. We saw a very strong rally, but nevertheless, munis still have not rallied back to where they were before the crisis began. At the same time, treasuries have rallied significantly, so treasury yields have come down significantly. Muni yields still are higher than where they were when the crisis started. Barron's does go on to discuss some closed-end fund opportunities, open-end fund opportunities, as well as individual bond opportunities in the municipal bond space. Be happy to share this article with anyone who's interested. What is interesting is Barron's does point out that if you're looking at the U.S. bond market and you go back to 2009, the supply of municipal bonds has not grown at all. So in 2009, there were about $3 trillion in municipals outstanding. In 2019, about $3 trillion in municipals outstanding. Compare that to the Treasury market. We had about $7.5 trillion in 2009. Now you have about $17.5 trillion. Or even the corporate bond market, where you had about $7 trillion outstanding, and now you have about $10 trillion outstanding in 2019. So municipals, if you think about supply and demand, yes, we took a big drop in demand last week, but supply has not been increasing. We have seen taxes and tax loopholes shift and change, where munis are the only game in town. So the supply-demand equation should revert back to where we were prior to the coronavirus once the world returns to quote-unquote normalcy. That's everything I've got. I know Brad's got a lot more to talk about since a lot took place in the municipal market. Turn it over to Brad. Good morning, Brad.
Thanks, Keith. Good morning, everyone. Just want to let you know that my heart is still racing from the last couple of weeks because it's unprecedented. Never seen anything like this. In no particular order. First of all, while Keith was speaking, he had mentioned that oil was picking back up. Apparently, Trump is setting up a meeting with Putin to discuss oil. And as Sal has mentioned in the past, keep an eye on oil and the VIX, because that will determine what the markets are going to do. More solid, stable oil price will probably firm up the markets a little bit. So I assume that's what's happening there. But what did the last couple of weeks mean? One, there was no liquidity in any of the markets. So it was just a frantic raise. There was a frantic cash grab, which makes me believe that every portfolio should have some cash in it, because you never know when you're going to hit a crisis like that. The other thing that was coming up at the end of the week were credit concerns. So you had this double whammy. The liquidity is definitely what pushed the bond market down so much, because there was just a absolute need to raise cash, on top of institutions trying to rebalance their portfolios from fixed income to equity, and they were selling bonds at any price. And lastly, for those who are in leveraged bond portfolios, it's a good lesson that these leveraged ETFs or closed-end funds are very dangerous, because even if they claim they're returning 6%, 7%, you can lose 50% of your value overnight. So, because if there's no liquidity there, none of this means anything. That's why sometimes the individual bonds are the best way to go. You really know it's there, and you know at the end of the day you're getting par, as long as you're in the right credit. I do think that the liquidity issue and the credit will continue in a smaller way. I'd rather not see it again, even though the opportunities are great. I think it's tough to stomach, and it's very scary when you see your and your clients' portfolios just getting depleted. So even though hindsight is, oh, what an opportunity, wow, I really missed that, just it's not a happy place to be until a year later, when you look back and you say, I took care of something I need to do. So even after the rally back, the spread products, corporates and municipals are still paying much better than the treasuries, but I would definitely be careful about the credits. Transportation bonds at the moment, all the transportation bonds were put on negative watch by Standard & Poor's last week. Obviously, the MTA being the poster child for a troubled operation, because the MTA was in trouble before this even happened. And obviously, it's difficult to see the MTA going out of business, but just be wary of those bonds. Port Authority bonds, Triborough Bridge bonds locally, airport bonds, New Jersey transportation bonds, all of these bonds, there's pressure on. I wouldn't necessarily be jumping into them here yet. These are the kind of things that you want to see that the recovery is taking place and that things are getting back to normal. Because the question is, where are these revenues going to come from? We're completely shut down. So far, the general obligations, water bonds, environmental bonds, sales and income tax bonds haven't been affected yet, but I'm certainly keeping an eye on this, and I know Keith will also, and we'll have to see what bonds really pull out of this. And again, it's really going to depend how long this is going to last. I'm not calling for any defaults or anything of that magnitude, but there could be some selling pressure if you get significant enough downgrades to push any of these bonds out of the investment grade range. And last and most important, I agree with Keith's comment about this time being a time where you get to spend time with your family, and you really, and then the way Keith said it so well, you put the material world on hold for a few weeks, and that's what it's all about. Do your business, take care of yourself, take care of your health, your loved ones, and I'm happy that this is going to be a calmer week. I think that there will be volatility. Markets will go up and down. I think that I hope we saw the worst of the volatility. I think that it'll be more orderly now that the government has come in and bailed us out, and hopefully we'll find some sort of cure or vaccine, and it'll just slowly create a calm into this market. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.